This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 1, 2026, and this is the New York session. Now, let's get into it. The dollar is flexing its muscles, while the rest of the global currency complex buckles under weight. We are seeing a hard divergence. Safe haven demand for the greenback is surging, even as equity risk appetite collapses to a reading of 14 out of 100 on the fear and greed scale. As of 9:30 ET on Wednesday, July 1st, 2026, the US dollar is the undisputed king of liquidity, pushing dollar-yen toward historic territory and compressing euro-dollar toward critical support levels. Let's look at what the data is screaming right now. Before we dissect the charts, we need to acknowledge the catalyst keeping this market on edge. The US economy just handed us a surprise. The June ADP employment report came in at plus 98,000 jobs, missing the consensus forecast of plus 118,000. That miss didn't just spark debate, it fueled a rush into safety. And looking at the broader headlines, we see oil prices continuing to soften as OPEC Plus prepares to raise output quotas by 188,000 barrels per day for August. Meanwhile, on the tech side, Meta announced it is building a cloud business to sell excess AI compute, adding noise to an already nervous equities sector. But for our Forex desk, the headline isn't oil or tech, it's that labor miss. Why is that data point driving such a violent rotation into the dollar? Because the market sees a crack in the foundation. You're looking at a scenario where cooling labor metrics, plus 98,000 versus plus 118,000 expected, are clashing violently with sticky inflation. Core PCE remains at 3.41%, and CPI is still stuck at 4.17%. Both are well above the Fed's 2% target. So, you have a central bank that cannot cut because inflation is alive, but also cannot hike aggressively without triggering a recession. That's why we see the 10-year minus 2-year Treasury spread flatten to just plus 30 basis points. It's a fragile equilibrium. The ADP miss doesn't mean the Fed cuts tomorrow. It means the Fed can't do much, and that uncertainty drives capital into the one asset that feels safest, the dollar.
And visually, that uncertainty is etched directly onto the euro-dollar chart. We are watching price action test the floor. Right now, euro-dollar is sitting at 1.1404. That is uncomfortably close to its 5-day low of 1.13543. We've seen a clear progression here. The pair has been grinding lower, shedding gains rapidly. The structure is bearish. If that 1.13543 level gives way, we aren't just talking about a wick. We are talking about a breach of the immediate support framework established earlier this month. The sellers are waiting at that line.
And they are being paid for by the institutions. If you look at the CFTC commitments of traders' data, the institutional footprint confirms this squeeze. Leveraged funds have executed a massive liquidation of euro exposure, reducing their net short position to negative 15,110 contracts, with a week-over-week deterioration of 13,103. They aren't just shorting spot, they are unwinding longs. Simultaneously, look at the dollar index. Leveraged funds are holding a net long position of plus 4,438. That is a coordinated, heavy hand pushing down on the single currency. The flow is undeniable. Money is leaving euro and entering DXY.
But I'd argue we are standing on a powder keg here. Look at the VIX. It's sitting at 17.65, which is deceptively calm. It's barely moved from its 5-day low of 17.49. Yet the fear and greed index is at 14. There is a massive divergence between implied volatility, which thinks nothing will happen, and actual sentiment, which is terrified. This compression usually precedes a violent repricing event. The market is complacent. When non-farm payrolls comes out on Friday, that low VIX is going to expand rapidly. We are seeing a liquidity trap where everyone believes the trend is safe. But the lack of hedging means a small move against the dollar could trigger a cascade of stops.
So we have a structural long dollar backed by institutional flows, facing off against a technical setup that is running out of room on the downside for euro. Let's zoom in on the second major player in this dominance narrative, the Japanese yen. Dollar-yen is climbing toward levels unseen since the mid-80s.
The chart tells a story of exhaustion meeting momentum. Dollar-yen is currently at 162.7935. It is literally 4 pips away from its 5-day high of 162.8395. We are touching the ceiling. Usually when price action hits a multi-day extreme like this with such little breathing room, you see either a sharp rejection or a consolidation phase. The upside range is compressed. The buyers are stepping on their own toes. The structure hasn't broken yet, but the distance to resistance is measured in ticks, not pips.
Which explains the ferocity of the positioning. You asked about flows earlier. Look at the yen. Leveraged funds hold a net short position of negative 97,922 contracts. That is enormous. And last week, they added nearly 100,000 lots of shorts, a week-over-week change of negative 98,892. This isn't retail speculation. This is institutional conviction. These funds are betting the yen will continue to weaken regardless of Bank of Japan intervention threats. They are pouring capital into the long side of dollar-yen because they believe the carry trade and the interest rate differential offer enough cushion against any verbal intervention. The flow data suggests the trend is locked in until a major shock occurs.
And the shock they are ignoring is domestic. The ECB President Lagarde recently stated she saw a perfect monetary policy outlook to raise rates. While that sounds dovish for the euro relative to the pound, it highlights a global trend of central banks being forced to maintain restrictive policies. However, the Bank of Japan is fighting a different war. The sheer volume of shorts in yen, as CIPHER noted, minus 97,000, means that any shift in Bank of Japan rhetoric or any unexpected strength in Japanese economic data could cause a catastrophic short squeeze. The market is pricing in perpetual yen weakness, but the geopolitical risks mentioned in today's headlines, meetings with Iran, supply chain shifts, always threaten emerging and Asian currencies disproportionately. The positioning is too crowded for comfort.
Crowded trades are risky trades. When 97,000 contracts are stacked on one side, the path of least resistance becomes explosive in the opposite direction. If dollar-yen fails to clear that 162.8395 level and reverses, we don't get a slow drift back. We get a liquidation event. The VIX at 17.65 suggests options markets aren't pricing in that move yet. That disconnect between the VIX and the fear/greed score is your early warning system. The gamma exposure is skewed towards stability, meaning a break above or below these 5-day extremes will hurt. I'm watching for a break of the VIX above 18.5 as the first sign that the calm is ending.
Let's pivot to the commodity proxy that acts as the barometer for this entire risk-off dynamic, gold. Gold has dropped from its 5-day high of 4,916.13 down to 3,977.94 today, down 0.7%. In a fearful market, gold is supposed to shine. Why is it bleeding? It's not bleeding, it's being sacrificed. You have to separate safe haven demand from liquidity demand. When the ADP mishit, algorithms didn't buy gold, they bought dollars. And to buy dollars, margin accounts needed cash. Gold is highly liquid. It is the first asset sold to raise cash and fund dollar longs. So, while the fear and greed index is at 14, gold is dropping because it's being used as collateral for the stronger bid in the dollar. The correlation has flipped temporarily. The fundamental long-term thesis for gold isn't dead. The inflation data at 4.17% still supports it, but the short-term tactical move is purely about raising dollar liquidity.
Technically, though, that drop looks like a classic liquidity grab. Gold opened at 4,050.85, dipped to 3,970.40, and recovered to 3,977.94. That long lower wick suggests that buyers stepped in aggressively below the psychological 3,970 mark. We are seeing a rejection of lower prices. The structure isn't broken, it's coiling. The critical support zone is clearly 3,970. If we hold that, we are looking at a base formation. If we lose 3,942.2, the 5-day low, we open up significant downside. But right now, the price action shows a defense of that lower boundary.
The flow data backs up that defense. While euro and yen shorts are exploding, look at the precious metals positioning. We aren't seeing the same massive liquidation event in gold as we did in the euros. The selling is opportunistic, not structural. Retail traders are likely chasing the dollar's strength and selling gold, but institutional smart money isn't dumping their physical or futures hedges en masse. The discrepancy between the price drop and the relatively stable institutional positioning suggests this is a retail-driven flush. Once the dollar consolidation begins, that liquidity will return to gold.
I disagree with the idea that this is just retail flushing. Look at the volume. The drop from nearly 4,900 to 3,977 in a few days is steep. In a low volatility environment like we have with a VIX at 17.65, this kind of velocity is abnormal. It indicates that leverage was unwound from the long side of gold. This creates a vacuum. If the dollar pauses here, gold might snap back, yes. But if the dollar continues to strengthen on Friday's non-farm payrolls data, that support at 3,970 could become a trap. Sellers will reload there. The risk isn't that gold goes to zero. The risk is that it gets chopped around as traders try to guess whether the next move is a bounce or a breakdown. Without a clear breakout above 4,000, gold is in limbo.
We have one final piece of the puzzle, sterling. Cable is holding at 1.32355, down 0.11%. Unlike the euro, which is being crushed, the pound seems to be finding footing. Let's see why.
The chart is boring, and that's the point. Cable is trapped in a tight range between a 5-day low of 1.31803 and a high of 1.32768. Current price is 1.32354. It's essentially sleeping. There is no directional conviction here. The daily candles are small bodies with short wicks. It's a consolidation pattern. It's waiting for a catalyst to break out of this box. Until we see a decisive close above 1.32768 or below 1.31803, the technical picture is neutral.
But underneath that technical neutrality, the flow is shifting dramatically. Look at the pound's speculative positioning. Net longs are now positive 7,567. More importantly, that is a week-over-week increase of plus 9,874. While euro shorts are expanding, pound longs are accelerating. Institutions are rotating out of the euro and into the sterling. They are using pound as a proxy for less bad G10 currency exposure. The flow data suggests that smart money is quietly accumulating sterling longs while shorting the euro. This divergence explains why pound is holding steady while euro is crumbling.
That makes sense fundamentally. The UK economy has its own idiosyncrasies, but the market perceives the Bank of England as having more room to maneuver, or perhaps less political pressure, than the ECB. With Lagarde speaking of rate hikes, the euro is caught in a vice, weak growth potential versus hawkish rhetoric that hurts the economy. The pound, meanwhile, is benefiting from that rotation. The labor data was US-specific, but the global risk-off vibe favors assets perceived as resilient. Sterling is riding that wave. The positive flow change of plus 9,874 is significant. It's a vote of confidence that isn't reflected in the price yet, because the price is still digesting the broader dollar strength.
Just be careful with that vote of confidence. Rotation trades can reverse instantly if the dollar strengthens further. If cable tries to break above that 1.32768 resistance and fails, those longs are exposed. Given that the fear and greed index is at 14, risk appetite is non-existent. Any pound long is essentially a bet that the dollar won't get stronger. That's a thin margin for error. The VIX compression means there's no protection. If the dollar spikes, pound falls faster than it rises. The positioning is attractive, but the risk management around it is precarious.
Let's bring it home. Apex, tie this together. We have dollar dominance driven by an ADP miss and sticky inflation, euro being squeezed technically and fundamentally, and gold acting as a liquidity sponge for dollar longs. What is the operational reality for the trader right now?
The operational reality is that we are in a dollar premium environment. Grid correctly identified that euro-dollar is testing the 1.13543 support, and CIPHER confirmed that leveraged funds are aggressively shorting euro. That combination creates a high probability setup for continued downward pressure on the euro, provided that level holds. Simultaneously, SPECTER warned about the VIX compression masking tail risk. We see that risk in the pound flow data. CIPHER showed a massive inflow of longs, but SPECTER rightly cautioned that these longs are vulnerable if the dollar spikes. The synthesis here is clear. Long dollar is the dominant theme, but the crowding is excessive. CIPHER showed minus 97,000 yen shorts. Grid showed dollar-yen hitting a 5-day high. The board is full. The risk/reward for initiating new long dollar positions is poor. Instead, the opportunity lies in the rotations. Pound is being accumulated while euro is dumped. That relative value trade offers better risk-adjusted returns than chasing the dollar direct. Watch the euro-dollar 1.13543 level. If it breaks, the dollar wins. If it holds, expect choppy consolidation as the market digests the ADP miss before Friday's non-farm payrolls.
So, the key takeaways for our viewers. First, the US dollar is strengthened by the ADP miss of plus 98,000, creating a safe haven bid that is overwhelming other G10 currencies. Second, technical structures are tightening. Euro-dollar is flirting with its 5-day low of 1.13543, and dollar-yen is testing its 5-day high of 162.8395, suggesting momentum is exhausting even as flows remain bullish. Third, positioning is incredibly crowded in yen and euro shorts, creating fragility according to SPECTER volatility analysis. Finally, pound is showing subtle signs of institutional accumulation, diverging from the euro's decline. Stay alert for volatility expansion if the VIX breaks above 18.5, but for now, the data shows a firm dollar and a cautious market. Thank you for listening to the ShadowQuant Forex edition. Tomorrow, we'll be watching the reaction to Friday's non-farm payrolls data and how that impacts these exact levels. Good luck and stay safe. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.